Hello everyone, welcome to the Stock Trading Tutor channel. If you would like to create a free Demat account with Alice Blue, click the link in the description and fill out your details. And you can get daily intraday recommendation calls and learn about robo trading software. Now let's look at the initial public offering. First, what is initial public offering or an IPO? An initial public offering is the first time a company issues shares to the public. This is when a private company decides to go public. In other words, a company that was privately owned until then becomes a publicly traded company. Before the IPO, a company has very few shareholders. This includes the founders, angel investors, and venture capitalists. But during an IPO, the company opens its shares for sale to the public. As an investor, you can buy shares directly from the company and become a shareholder. Now let's look at how the shares are allocated in an IPO. There are different investor categories when it comes to IPOs. This includes qualified institutional buyers, non institutional investors, and retail individual investors. The allocation of shares differs for all of the above groups in an IPO. As an individual investor, you come under the last category, which is retail individual investors. As an individual investor, you are allowed to invest in small lots worth rupees 10,000 to 15,000. You can apply for a maximum of rupees 2 lakh in an IPO. The total demand for shares in the retail category is judged by the number of applications received. If the demand is less than or equal to the number of shares in the retail category, you are offered a full allotment of shares. When the demand is greater than the allocation, it is known as oversubscription. Many times, an IPO can be oversubscribed 5 times over. This means that the demand for shares exceeds the supply by 5 times. In such cases, the shares in retail category are offered to investors on the basis of a lottery. This is a computerized process that ensures impartial allocation of shares to investors. Now let's look at why a company goes public. The first reason is to raise capital for growth and expansion. Every company needs money to increase its operations, create new products, or pay off existing debts. Going public is a great way to gain this much needed capital for a company because this helps in growth and expansion. The next reason is allowing owners and early investors to sell their stake to make money. It is also seen as an exit strategy for initial investors and venture capitalists. A company becomes liquid through the sale of stocks in an IPO. Venture capitalists sell their stock in the company at this time to reap returns and exit from the company. Next is greater public awareness. IPOs are star marked in the stock market calendar. There is a lot of buzz and publicity around these events. This is a great way for a company to publicize its products and services to a new set of customers in the market. Now let's see how you can benefit from an IPO. The first benefit is first mover advantage. This is especially true when reputed companies announce an IPO. You get a chance to buy the company's shares at a much lower price. This is because once the company's shares reach the secondary market, the share price may go up sharply. Next is high returns. If the company has a potential to grow, buying shares in an IPO can benefit you. Strong fundamentals of the company mean that it has a good chance of growing big. This can be advantageous to you as well. You stand a chance to earn good returns over the long term. Next are the listing gains. When a company gets listed on the stock market, it may be traded at a price that is either higher or lower than the allotment price. When the opening price is higher than the allotment price, it is known as listing gains. Generally, investors expect an IPO to perform well on listing due to factors such as market demand and positive bias. However, this does not always happen. It is possible for a stock price to drop by the end of the first trading day too. In reality, listing gains may not actually result in good returns for the investor in the long term. So, if you are a trader interested in quick returns, it may be suitable. But for long term investors, it is important to identify a company that can offer high returns 5 or even 10 years down the line. Thank you for watching this video. For more videos on stock markets and trading, please subscribe to this channel. If you would like to create a free Demat account with Alice Blue Financial Services, click the link in the description and fill out your details, and you can get free recommendation calls for intraday trading and also learn about robo trading so you can utilize it for your trading.